Let's start with impairment of long-lived assets. Okay, those are the three topics, fine. So please stop me if you have any questions as I'm going through the notes. We'll do the notes, and then we'll get to the multiple choice questions. All right. There are two sections, one for ASPE and one for IFRS. Okay. I'm going to be using, let me just move this around here. I'm going to be using the handbook section 3063, which is the ASPE section. I'm going to bring in the IFRS differences. Now, the truth is, I hate to tell you this, but we have to be careful with the differences here. There are a few that are significant. There's not that many. That's the good thing. The problem is the differences that there are fairly significant. Okay? Now, here is something that is important. The scope is different between IFRS and ASPE. People, the reason this is important is because if you get a certain asset and you don't know which section it goes into, you're not going to get the right accounting. So I'm not worried they're going to ask you a question on, is a certain asset included in a section? They're not going to ask you that. They know it's open book. I'm much more worried where they'll just, they'll be dealing with a certain type of asset, and you're going to be sitting there and you're going to mess up and put it in a different section. And because of that, you'll get the accounting wrong. So ASPE applies to mainly PPE and intangibles with finite lives. But IFRS includes that, but has three other things. Intangibles with indefinite lives, not just finite lives. Goodwill. And investments in current assets, impairment not dealt with in other standards. Okay. This third one I don't care so much about. It's kind of like a catch-all. But the other two definitely could come up. That's a big deal. If these come up and you're sitting in IFRS, they're in the section. If you're sitting in ASPE, it's a different section. Okay? Now, people, what I like to do for this section is I'm going to divide up the section. You don't have this in your notes. It's not a big deal. I'm going to divide up the section into 4 parts. I don't know why I like to do that. I just feel it fits nicely. It's easier to remember. So I'm going to divide it up into 4 parts. Part number 1, let's call recognition and measurement. Okay. How do you recognize, how do you measure an impairment? And here we have a major difference between ASPE and IFRS. Under ASPE, what you do is you look to see an impairment loss is present if the value is not recoverable. So now I need a definition. What's the definition? If the carrying amount is not recoverable, right here, if it exceeds the sum of the undiscounted, everybody note that, undiscounted cash flows, its future cash flows from its whatever expected use, and eventual disposition. Okay, so what you have to do is you have to take the cash flows, the future cash flows, plus whatever you're going to get if you dispose of it, compare that to the carrying amount. If it's lower, we have a problem. Fine. But now look at this magic trick. If it's not recoverable, the carrying value is lower, then we have an impairment loss, but guess what? You don't write it down to that number we just figured out. You write it down to the fair value. Does everybody get what I just did? I gave you a formula to determine the write-down. Okay, that is called recoverable. If it's not recoverable, we write it down. But then I said to you, we don't write it down to that number. We write it down to a different number. We write it down to its fair value. Okay? I'll show you an example in a few minutes. Now, this I'm not worried about. How do you test recoverability? If you know the formula, I'm not worried about this. Estimating future cash flows, that's hard to test. And I just think whatever information they give you, estimating future cash flows, that's fine. This is whatchamacallit. There's a few little points here on this slide. You can just read it on your own. I don't really think the slide is all that important. Okay. More importantly, let me show you an example. A company owns a piece of equipment, fine. The company is going to use equipment for 5 years, okay, and they're going to sell it at the end of 5 years for 15 grand. All right. How much cash flow is it going to generate? 18,000 a year. What's the carrying value? 100. What's the fair market value? 90. Do I have an impairment loss? The answer is no, because 5 years at 18,000 cash flow is 90,000 plus 15 is 105. Let's go back. 105. My carrying value is 100. I'm good. My carrying value is below my recoverability. I'm good. Now, people, let me ask you guys a question. What would happen if I dropped the cash flows to, let's say, 15,000? To 15,000. Okay? So the carrying value, so the cash flows would be whatever. You can figure it out. Do I have a write down, yes or no? If I drop the cash flows to 15,000. Okay, so 1 second. Yes, I'm getting an impairment loss, good, and I got the right number, very good. 10,000, very good. 15,000 times 5 is 75, plus 15 is 90. You write it down to 90. Okay, how about okay, let's go 16,000. What's my write down? 16,000. Okay, I got one answer. It's not the right answer. Any other answers? What's my write down? Cash flow 16,000. Right. Vladimir's correct. So people, what's 16,000 times 5? 16,000 times 5, I can't write with this stuff. 16,000 times 5 is 80,000. Plus 15 is 95. Why is it a write down? Because 95 is less than 100. What do you write it down? To 90,000. I don't care. As long as my recoverability is below my carrying amount, I really don't care what the number is. I'm going to write it down to the fair market value of 90,000. People, just so you understand the logic here, you know what the logic is? The logic is, as long as my asset side of the balance sheet is not greater than the fair market value, I'm good. I'm good. It's not fair. No, someone just said I cannot hear or see you. What just happened? It's not fair for me to record something on my asset side of the balance sheet that is greater than my fair market value, because I can't sell it and get it. I'm very happy you computed a formula and the recoverability you're telling me is 95,000. But so what? The fair market value is 90. You're never allowed to have something on your balance sheet that's above the fair market value. And it's also not fair the other way. What if the recoverability is 88,000? But I could sell it for 90. So why do I have to write it down to 88? That's the logic. Okay. Someone here says they cannot see or hear me. Can you hear me now, Shalini? Can you see me now? I'll just say, please check on your end. I guess everyone else can still hear me and see me. Okay, anyway, just give me 1 sec. I'll just, of course, if you can't hear me or see me, I don't know if you're going to get this, but I can hear you now. Okay, good. Excellent. Okay. All right. So, people, that is ASPE. Now, to make life nice and fun, along comes IFRS. Still dealing with our first issue here of write-downs. What's a write-down? IFRS says, okay, you got a formula. A little different. You take the higher of the fair value minus the cost to sell. What are the costs to sell? The incremental costs. Or the value in use. Well, what the heck is the value in use? The value in use is the present value of the cash flows plus the disposal, plus the disposal minus deducting disposal costs. People, this is very different. This is obviously very different. Okay, I don't even know if it helps. Sometimes I do this. I say, okay, well, let's count the differences. It's like, I don't know, like everything's different. It's a formula of A or B. It's the higher of the two. Okay, you know, there's no such thing as your formula computes a recoverable amount and then you write down to a different amount. No, this you write down to whatever the higher of the two is. That's what you write down to. That's recoverability. You know, but it's got the cost to sell. It's got the present value of cash flows. You even have disposal costs. We didn't even have that in the last one, disposal costs. So this one is very different. Okay, and this is the IFRS formula. So it obviously makes a very big difference if you're in IFRS or ASPE. Now, what happens? Look at the first important line here. What if I only know one of the two? What if I only know value in use or fair value? Then forget the formula. Just do the one you know. Okay, that's important. And as I just said, there's no such thing as this business of writing down to fair value. That's part of the formula. I write down to the higher of the two. That's my recoverability. It's not like ASPE. And yes, you use a discount rate. So, is everybody good, people? That is what I call issue number one. Issue number one, what's my impairment formula? Do I have an impairment? Okay, issue number two. When do I test for recoverability? Now, people, before I start showing you the details, because again, we're going to have differences between ASPE and IFRS. What's the golden rule? Who makes us work harder, ASPE or IFRS? Good. Everyone's getting it. Good. IFRS. Keep that in mind. Under ASPE, you only test for impairment when there's factors that indicate there may be an impairment. Does everybody get what I just said? You only test for impairment if there's factors that indicate there's an impairment. The test is a lot of work. Okay, you may not think it is, whatever, but it means I have to start going and projecting cash flows. That's a hassle. Okay, it's a hassle. I don't have to do that if there's no factors that indicate an impairment. And this is a joke. What factors indicate impairment? Basically, anything. And I'm serious. It's hard for me to conceive of an example that they could actually give you where you're going to be tricked on whether or not it's a factor that indicates impairment. I have no idea. Basically anything. Use your judgment. The handbook gives a bunch of examples, like who cares? Don't waste time memorizing these examples. I don't know. Anything they tell you that indicates an impairment is probably going to be an indication of impairment. Like I say, you'd have to, there'd have to be a lot of bells and whistles to have something that really looks like it's an indication of impairment, but it's not. Okay, that's going to be weird. Okay, fine. That is not IFRS. IFRS says you're going to work more. IFRS says what you have to do is you have to look for indications of impairment at every reporting period. Don't just say, do I see any indications? And if you don't, you have to look for them. And then if you see them, of course, you have to test. So in both IFRS and ASPE, people, does everyone understand the difference? It's almost like a subtle difference, but it's not so subtle. Under ASPE, I don't really have to do anything proactively. If I come across an indication of impairment, of course I have to do the test. Under IFRS, I have to look for indications of impairment. And if I don't find any, fine. And if I do, then I have to do the test. That's the difference. It's more active work. Okay. This slide, very unimportant. This is right out of the handbook. The handbook goes into what are external, what are internal factors of indicators of impairment. As I said to you, I don't care. You try and come up with an example to trick me on factors, indicating impairment. I don't think it's so easy. Don't waste your time memorizing this slide. I'm not showing it to you. I'm just giving you examples of what are factors of indicators of impairment. Come on, if the case gives you, or if the multiple choice question gives you a hint of a problem, there's your factor. There's your factor. What type of a hint are they going to give you that's a problem that you're going to sit there and say, well, that's not really a factor of impairment? I guess if it has nothing to do with the asset, okay, fine. But, I don't know, look at these things. Obsolescence, physical damage, I don't know. Okay, so this to me is very, whatchamacallit, I think this is very easy. And by the way, these are only guidance. So it's not like it even has to fall into this chart. Then it might be a little harder. But these are examples. Okay. Still on the second issue. Guess what? IFRS has exceptions. You might want to know the exceptions. First exception. Remember I said at the beginning that IFRS includes the scope is broader? Look at this. Intangibles with indefinite lives. That's not even in the section for ASPE. Intangibles not yet ready for use and goodwill. That's not in the section for ASPE. All of these have to be tested annually for impairment, even if there's no indications. Wow. I got to do the test annually. When? Anytime during the year, but be consistent every year. Anytime. But don't change it every year. 1 year January 31st, 1 year April 1st, no. Same time every year. Now, look at this last one. What happens if I have an asset that I purchased during the year? I bought it September 1st. Okay? It's an intangible asset with an indefinite life. Fine. I got it tested once a year. Let's pretend my year end is December 31. I bought the asset September 1st. Do I have to test it before December 31? On an ongoing basis, I want to test it February 1st. I bought it September. Do I have to test it before December 31? Or can I wait until do it February 1st? That's going to be the time I'm going to do it every year. Answer, yes, you have to test it at least once before the current period. I don't care when. Test it December 31 if you want. And then test it again February 1st on an ongoing basis every year, February 1st. They want some assurance. I'm not going to let you get away with getting an asset the middle of the year and telling me I'm not going to test it by year end because I'm going to start after year end. That's going to be my annual time period when I test it. Okay. Everyone good? None of this required under ASPE. Okay. People, that was the second issue. When do we test? This is called issue number 3. I am allowed to group assets under both ASPE and IFRS. Why does that matter? Because I'm looking at a write-down. And the write-down could be different if I group my assets. So my third issue is, how do I group these assets? How do I write them down? All right. Let's talk ASPE. Under ASPE, you're going to group the assets as well as the liabilities, the lowest level for which you have an identifiable cash flow. Okay. Oops. So, people, I'll tell you what I'm not so worried about. How are you going to know which group of assets to combine that produce a cash flow? They will have to tell you. I look at this very easy when we talk about these groups. I don't think it's very hard to know what the group is. They'll give you the group. How are you going to know? How are you going to know if accounts receivable plus inventory plus capital assets make up one group? I don't know. They're going to have to tell you how the cash flows come from those assets. And ASPE includes liabilities. Now, here's the weird thing. Check out the group. The group includes assets not covered by the section. Really? Yeah. Inventory, accounts receivable. They're included in the group. Okay. Goodwill. That's included in the group. Okay. But that's only if the asset group is or includes a reporting unit. So I'm not getting into that really right now, but that's only if it includes a reporting unit. Once again, not a big deal. I think they would tell you. Okay. But, major but, you're going to include other assets in the group, but you're not writing down the other assets. If you have an impairment loss, you're going to be allocating the impairment loss to only the assets in this section. So, for example, if my group includes accounts receivable, I don't care what the write-down is, I'm not writing down accounts receivable because that's a different section of the handbook. Inventory, nothing to do with this section. This section's called impairment of long-lived assets. That's not inventory, it's not long-lived, neither is accounts receivable. How do you write it down? Oh, really easy. Prorated, but only against the long-lived assets. So you see what we're going to do. I'm going to group the assets in order to determine if we have a write-down, and then if we have a write-down, I'm going to apply the write-down against only the long-lived assets. Okay, now, never go below fair market value. Why would I? I said before, as long as you got fair market value, I can get fair market value. Just don't go below that. Okay, that's going to affect our numbers. Now, that was ASPE. IFRS has a little difference here. They give a name to the group. The name of the IFRS group is Cash Generating Unit, a CGU. It basically means the same thing. It's the smallest identifiable group of assets that generate independent cash inflows. And this is a little interesting. You're not supposed to include the outflows. Okay, fine. And the other little difference from ASPE, it does not include the carrying value of liabilities, whereas ASPE does. Unless, watch the exception, unless you can't do a determination, I'll give you an example in a second, unless you can't do a determination without the consideration of the liability. For example, if a company is selling a mine and there's a liability for restoration costs, once the mine is sold, the liability gets transferred with it, that would be included. Okay, fine. So people, this is not a big difference compared to some of the other stuff in this section. This to me is a small difference between how they compute the group. I'm not so worried about this because I really believe if they give you a group, they're going to tell you what the group is. I think it's hard to have you guys come up with the actual group. The hint's going to be so strong that effectively they're telling you what it is. They'll tell you how the cash flows are produced. I don't know, by which assets. Okay, that's your group. Now, this is an interesting point. The CGUs are supposed to be pretty consistent, but be careful. It's not, they don't have to be identical. In other words, am I allowed to change my group from year to year? The answer is yes. You have to be reasonably consistent. But if one asset changes, I don't know, it produces cash flow for a different group, fine, take it out of the group. All right. Goodwill is kind of the same thing. Okay, again, not such a big deal, but you're kind of allocating the goodwill. You're allocating the goodwill. So the allocation is the lowest level within the entity. Okay, fine. All right, not large operating segment. Okay, fine. Also, I don't think that's an important thing in the section. Okay. Okay, fine, foreign unit. Okay. Now, you guys know we have, I don't know if I want to say the word rule, but do we like goodwill? The answer is no. Why don't we like goodwill? Nobody ever trusts it. People are always worried that companies are going to set up goodwill. It's a very difficult thing to get your head around. Do they really have goodwill? It's kind of subjective. So goodwill does not have a lot of favorable, people are always worried about it. Okay, fine. So keep that in mind, because now we're still on the third area here, grouping, the groups. If you have goodwill in your group, guess what you have to do? You have to test the group annually for impairment. Okay? Now that's interesting. Why? Because goodwill taints the group. Goodwill taints the group. Sorry. Oh, I did just asking a good question. I have a question here, just one sec, whether or not it's only That's a good question. Oh, 1 second. I'm sorry. No, Aditya. No, sorry. Oh, God. Okay, there's a very easy answer. I'm sorry. The answer is only under IFRS. The answer, of course, only under IFRS. Why, of course? Goodwill is not in the handbook section for ASPE. That's one of the differences. Okay, so yes, I should have known that right away. Okay, sorry. Okay, so yes, only IFRS. So they don't trust goodwill. So what they're saying is, sorry, you got goodwill sitting in your group. Okay, please test it annually. Too bad. Now, would you believe there's even an exception for this? Check out this exception. You got to meet all of the 3 criteria. Look at this. If I have goodwill, if I have goodwill in my group, I can get out of testing it if, check out the 3 points. The assets and liabilities making up the unit have not changed significantly since the most recent recoverable amount. You don't think you have a write-down. The most recent recoverable amount, or you don't think it's changed. The most recent recoverable amount resulted in an amount that exceeded the carrying amount by a substantial margin. So even if I had to write down goodwill a little bit, it wouldn't hurt me. And there's been no change in events or circumstances. So people, you know what they're trying to say? They're trying to be nice. They're trying to say, if you have a group and you can tell me that the group really does not probably have a write-down, even though it includes goodwill, but there's been no change and the carrying value is way below the recoverable amount, you're good, then you don't have to test it every year, even though you have goodwill. It's an exception. Okay? Now, when do I have to test the group if I have goodwill? Anytime. Anytime during the year. Once again, same time every year. Same, look at the second point, same as before. What if you got goodwill, I don't know, September 1st? Do I have to test it by December 31, by my year end? The answer is yes, same as before. And this is an interesting point that's a little new. Different CGUs can be tested at different times. You do not have to be consistent. The CGU itself has to be consistent from year to year. That you're supposed to be. But I could have one group on April 1st. I could have another group on May 1st. That's okay. As long as the group April 1st, every year is April 1st. Okay. People, is everyone good? Last issue, and then we're getting into the questions. Number 4. How do you allocate the impairment loss to the CGU, to the group? Now, I have good news here. People, the good news is it's kind of the same for ASPE and IFRS. Even though, okay, there's no goodwill under ASPE, so who cares? But the actual formula is going to be the same. What you do is you write it down against goodwill first. Reduce goodwill to 0. And if you have any remaining amount, then simply prorate it. Look at the example. A company has the following assets. They got a building of carrying value 200, equipment 50, and goodwill 25. Fine. Let's talk IFRS. I'm giving you the impairment loss. Everyone see that? See the 50,000? That's issue number 1. I just gave it to you. All right. How do I allocate the 50? Very easy. Wipe out the goodwill. Goodbye. There's 25,000 written down. Take the remainder Take the remainder 25,000 and just do it prorated over the 250. This is 250, 200 plus 50. So building gets 200 divided by 250. How much is that? 80%. So take 80% of 25 is 20,000. So guess what your building is? Your building is 200 minus 20. Your building is 180. That's your building. Your equipment, well, that's going to be what? 50 divided by 250. That's 20%. So take 20% of 25. That's 5,000. So your equipment's going to be 45. Well, that's how you write it down. You just prorate it after you've knocked off as much as you can from goodwill. Everybody get that? Now, don't write it down below its recoverable amount, because part of the recoverable amount is the fair value, and the value in use. So I should not be able to write it down. Remember, my write down is the higher of the two. I keep saying you're not supposed to write something down below your fair value. No kidding. That makes sense. Also, no write down below 0. Okay, I'm good with that. All right. So let me show you an example where this plays out. Check out this. Here's your group. Building, equipment, furniture, I'm giving it to you. Do you have a write down? Yeah. Issue number 1, you got a write down of 100,000. Fine. Look at my group. 600,000, so building gets 60%. 300 divided by 1,000,000 is 30. 100 divided by 1,000,000 is 10. Fine. I got to allocate the 100,000 based on, let's prorate it against all my long-lived assets. Very good. Building, equipment, furniture, fine. So 60% of 100 is 60. Good. 30% is 30. Good. 10%, very simple. Excellent. That's my adjusted carrying amount. There's no goodwill. Fine, so ignore it. But what happens in this example? What if I take the fair value, okay, of the building and I say it's only 550? Everything else is the same. Everything else is the same. Carrying value is all the same. The pro rata, all the same. I want to allocate 60% times 100,000 write down. So I want to allocate 60,000 to the carrying amount, but I can't. Because if I do that, 60 minus 600 is 540. But the fair value is 550. So I'm restricted to writing it down by 50,000. So my carrying amount is 550. So now what do I do with that $10,000? I want to write down equipment by 30% times 100,000. That's 30,000. So you know what you do? There's a typo here. People, you know what you do? You take that remaining 10,000, which you did not apply to the building, and you prorate it on these two. Okay, one sec. Prorate it. 300 plus 100 is 400. So that means equipment is 75%. Okay. And furniture is 25%. So what are you prorating? 10,000. What's 75% of 10? 7,500? That should be, okay, that should be not 7, that should be 7.5. So what's 7.5? This is correct. 7.5 plus 30 is 37.5. And what do you do with furniture? I don't know. You write it down. Okay, I'm doing 10%, but I got to allocate that 10,000. How much? 25%. That's 2,500. Okay, fine. 2,500 plus 10,000 is 12,500. That's it. That's how you do it. If you're maxed out in one of the items, just go to the other item, items plural, and just prorate it among the other items. Bang, and that's it. Any questions? Is everybody okay? Everyone's good? All right. All right, this last thing, I don't know, I kept saying there's 4 issues, okay, like how you actually write it. I don't know, you want to count this number 5? I don't care. Okay, if you want to count this number 5, it's really small, and that is, am I allowed to reverse a write-down? Well, guess what? Under ASPE, no. Not much to discuss. Under ASPE, no. Under IFRS, yes. Under IFRS, it is possible. Now, people, it's really easy. All you have to remember is, how do you reverse it? Basically, it's the same way you wrote it down. If it's a group, just reallocate it to the group. Okay? It's really the same way that you wrote it down, you reverse it. All right. Now, that's the key point is this last point in bold. Okay? You don't do it, obviously, because of passage of time or something like that. There's got to be a reason based on the formula that you can, whatchamacallit, you reduce it. Okay, fine. How do I do it? No problem, prorata. One major exception. Guess what item you're not allowed to reverse? Goodwill. Goodwill. So once you write down goodwill, you're finished. You can't do anything with it. Okay? Even if you have goodwill sitting in a group, don't allocate anything to the goodwill, don't reverse it. And people, please be careful. Look at this last sentence. Just make sure everyone understands this. This is not recording it at fair value. You're simply reversing. You're not going above the reversal. What you reversed previously. You're reversing something. Okay. Questions? No. Okay, someone is asking me a question. If you go above reversal, do you go to OCI? I don't go above reversal. What do you mean if I go? I don't go above reversal. Okay, I'm not allowed. I stop at reversal. That's it. Can't go above it. The reason you can't go above it is that would change the whole accounting here. That would mean you're recording it at fair market value. Who said you could do that? I didn't say you could do that. All you're doing is reversing a write-down. That's what reversing means. Whatever you wrote down with, you reverse it. Any other questions? Everyone good? Okay. So people, look, what I want you to look at, okay, disclosure, look at your own, whatever scope of your own, okay, fine. What I'd like you guys to look at are the multiple choice questions. Now, I don't know why, but one of these days I got to fix this. The questions go in the reverse order, don't ask me, okay, kind of I think of the notes I'm covering today. So can you guys please look at question 5 to 9, 5, 6, 7, 8, 9, it won't take you that long, and task-based simulation 1. Please do question 5 to 9 and task-based simulation number 1. I'm going to give you a few minutes here. I won't have to give you that long. Number 1's true or false, and it won't take you that long to do this. Okay, so I don't know, I'll give you about 7, 8 minutes, something like that. I've got 7:28. You want to say until about, I don't know, 8:35. If you need a few more minutes, you can take a few more minutes. Okay, please do question 5, 6, 7, 8, 9, and task-based simulation number 1. Then we'll take them out. Okay, I'll write it down so you can all see it. Okay, please do questions 5 to 9 and task-based number 1. Okay, just one sec. Okay, everyone good? All right, again, just take out about 7 minutes or something, and then we'll have a look, we'll take them out. Let's have a look at these questions. All right, question number 5. What's the answer? Some of these I'll show you how we get them. Just make sure people got it. What's the impairment loss for number 5? That would have to recognize in year number 2. What'd you say? Not D. C, right. Okay, well, the answer is C. Okay, look. Let's calculate the recoverable amount. Good. Okay, so a number of you have it here. Let's calculate the recoverable amount. Fair value is $130,000. Fine. This is IFRS. So let's do the value. We have to do it's going to be the greater of the two. So, okay, fine. What's the value in use? Well, the cash flows are $45,000 times 40%. That's what it says. It says the future annual profits will be reduced by 60% per annum. So you're only getting 40%. So 40% of 45 is 18. What's the present value of 18,000 over 8 years? It's 7%. It works out to 5.97. Fine, multiply by 18,000. So you got 107,460. Okay. So what's the recoverable amount? The recoverable amount is the higher of the two. The winner is fair value, 130. All right. Now, not finished. What's the carrying value at the end of year 2? Well, the asset was $300,000 over 10 years. We're depreciating. So that means we're depreciating $30,000 each year. At the end of 2 years, I've got $60,000 of depreciation. What's my carrying value? 300 minus 60 is 240. So my carrying value is 240. Okay. So do I have a write-down? Yeah, I have a write-down for sure. I have a write-down. Okay, my carrying value is only 240,000. My fair value is only 130. Fine. What's my write-down? The difference between the 240 and the 130, which is 110,000. Questions? My carrying value is higher than my recoverable amount, so therefore I have a write-down. And I write it down to the fair value, and I write it down, this is IFRS, I write it down to the higher of the two, which was 130. Answer is C, 110,000. Any questions? People, does that make sense? Everyone good? All right. What'd you do for number 6? Which of the following is the amount the company must write down the plant as at the year end based on ASPE? Number 6. Anyone get it? Okay, good. Vladimir, very good. A. Okay, good. Okay. Why is it A? ASPE, no discounting. What's my cash flows? My cash flows are $100,000 for 25 years, fine. Plus, I'm going to get another $500,000 when I get rid of it. The residual value is $500,000. So my recoverable amount is $3 million. What's my book value? What's my carrying amount? 3.6. Got a problem. But don't write it down to $3 million. So there's no way the answer is B. It's not $600,000. What's my fair value? $3,000,004. Okay, so let's write it down, $200,000. So the answer is A. No tricks, people, just following the formula for ASPE. Does that make sense? Anyone who didn't get it or anyone that has any questions? Everyone good? All right, number 7. Nothing for me to write. These are the carrying values, fine. Which of the following is the amount of which inventory would be reflected? Okay, so number 7. What's the answer for inventory? Answer is A, right. People, remember what we said. Inventory may be included in the group, but you're not writing down inventory based on this section. However, the fair value of inventory is $65,000. So What's inventory? 1 second. The rule for inventory is lower of cost or recoverable, lower of cost or NRV, net recoverable amount. So, okay, what's the lower of cost or net recoverable amount? In this case, it's 60,000 versus 65. So the answer is 60. That has really nothing to do with this section. Yes, it's included in my group, but I'm writing it down based on the inventory section of the handbook. So I don't have anything to show you for number 7. The answer is A. Okay, 60,000. Now, what about 8? How do you reflect the equipment? Good. The answer is B. Very good. So, look. I tell you the impairment loss. I'm making your life easy. You don't have to do the first part of the lecture. You don't have to compute the impairment loss. I'm giving it to you, $400,000. You just have to allocate it. Notice also I gave you the group. I didn't have you guys figure out the group. That's very likely. They would give you the group in a question like this. But you don't allocate the loss on accounts receivable or inventory. Forget it. That's not long-lived assets. So you only have 2 assets here, so it's easy. So you allocate the 400,000, what? 1 million divided by 1,086,000 is 59%, and 700 divided by 1,086,000 is 41%. So allocate 59% to 400 is 236. 41% to 400 is 164. And that's it. So you write down the plant to 764, and you write down the equipment to 536. Question number 8 asks you about the equipment. So the answer is 536, which is B. Now, the truth is, people, the next one was really easy. I can give you number 9, and you could even have done it in your head. You only have one other remaining asset. So if I tell you in question 9 that the equipment is going to be restricted to 550, then this is wrong. I can't write it down to 536. I have to write it down to 550. So where does that extra 14,000 go? There's only one place it can go. It goes against equipment. So equipment's going to be what? 764 minus 14,000. So lo and behold, what's the answer? 750. That's the easy way. That's a shortcut way of figuring it out. You only got one other asset. There's nothing to prorate. I really should be prorating 14,000. Prorating over what? I only have one other asset called plant. So let's write it down against plant. You don't have to do any math here. If you really want to see it, the fair value of the equipment is 550. The loss is 400. So therefore, 150 goes against equipment, and the remainder, 250, goes against the plant. Same thing. That's 750. Okay. Everybody good? People, does everyone understand? 9, the answer is C. All right. Let's just do the true-false together. Number 1. A company must test all of its CGUs for impairment at least once a year. True or false? True or false? Okay. I think I got both directions here. Okay, guys, false. You only have to test, right, Vladimir is correct. You only have to test the CGU every year if there's goodwill in the CGU and you don't meet the exception. If there's no goodwill, I do not have to test it every year. I have to look for, under IFRS, I have to look for indications of impairment. So number 1 is false. Number 2, a company does not have to test any CGU for impairment at the end of each fiscal year, regardless of the nature of assets included in the CGU. True or false? True? Nope, true. I'm allowed to test it any time during the year. It's true. This says do not have to test any CGU for impairment at the end of each fiscal year. That's correct. I don't have to test it at the end of each fiscal year. I could test it any time during the year as long as I'm consistent from year to year. The answer is true. Number 3, if goodwill has been allocated to a CGU, it will always be tested for impairment once a year. True or false? Okay, tricky one. People, the answer is false. The answer is false. You know why? If you have indications of impairment, you could have to test more than once a year. This says it will always be tested for impairment once a year. No. If goodwill is in the CGU, it could be tested more. It should be tested more if we have indications of impairment. What if I tested February 1st, and now my year end is December, and now there's indications of impairment? You got to test it again. What do you think you're supposed to do? Say, oh, I don't care, I tested it last February? That is not going to work. Last one, number 4. Whether a company must test a particular CGU for impairment at the end of each fiscal year is dependent upon whether it acquired any subsidiaries during the year. True or false? False. Good, false. And the reason is because we said, yes, if you bought something during the year, you have to test it at least once before the end of the year, but it doesn't have to be at the end of the year. It could be, but it doesn't have to be. So here it says at the end of each fiscal year. It's not true. It doesn't have to be tested at the end of each fiscal year. It could be before. It just has to be tested at least once. Okay. People, any questions? Everyone good? All right. People, we will take, I'm just going to turn off the recording here because that wraps up the impairment. I hope everyone watching the video found the recording helpful on impairment of long-lived assets.